Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in company filings. I have a doozy for you today. Think stormy weather, financial hedging, and a company playing a daring game of energy finance. We're diving into Hallador Energy Company's second quarter report for 2025. And folks, this isn't your average earnings announcement. They are juggling power plants, coal mines, and a whole lot of financial maneuvering that makes even seasoned investors raise an eyebrow. So what's the big picture here? Hallador Energy is in the business of producing coal and generating electricity. And as you can imagine, in today's volatile energy markets, that's a pretty complex operation. They seem to be pushing a strategy that transforms them from just a coal company into something more like an independent power producer, NIPP. This means they want to own and operate power generation facilities and sell electricity directly to customers rather than just selling coal to those who do. Let's jump straight into the numbers because that's where the real story is. On the asset side of things, you see they have around $139 million in current assets. That's the short-term stuff like cash and inventory. And their total assets are about $409 million. Now compare that to their liabilities, which are a hefty $287 million. This means they have a significant amount of debt and other obligations compared to what they own. One number that immediately jumps out is restricted cash. It's over $23 million for June 30, 2025. Now, what does restricted cash really mean? It's basically money that the company can't easily spend because there are conditions attached to it. In Hallador's case, a big chunk of that restricted cash is tied up as a compensating balance for their term loan. Think of it as a security deposit required by the bank to keep their loan in good standing. Speaking of debt, their bank debt is a significant piece of their financial puzzle. They have long-term bank debt totaling $26 million and a current portion of $17 million. When you add it all up, that's a substantial $43 million in net bank debt. It's important to see how this debt is being managed, especially when they mention discussions about refinancing their credit agreement. Now, let's talk about how much money they are actually bringing in and spending. Total sales and operating revenues for the second quarter were just over $102 million. That sounds good, but when you look at what they spent to generate that revenue, things get interesting. Their total operating expenses were over $91 million. This leaves them with an income from operations of nearly $12 million for the quarter. That's a positive number, which is good. But remember, this is before all the other costs of doing business like interest. And that interest expense is not small. It's over $3.8 million for just the 3-month period. This is a significant cost that eats into their operating profits. After all expenses and taxes, they posted a net income of $8.2 million. That's a win for the quarter. But importantly, when you look at the same period last year, the second quarter of 2024, they had a net loss of over $10 million. So they've definitely turned a corner from last year, but the interest expense is a big factor influencing their bottom line. Something else that affects profitability is the number of shares outstanding. You see they've got about 42.6 million basic shares outstanding. This is important because net income per share is calculated by dividing net income by the number of shares. So even if net income remains the same or high number of shares means a lower earnings per share. Looking at their stockholders' equity section, you see a retained deficit. This means that accumulated losses over the company's history have outweighed its accumulated profits. Their retained deficit is over $67 million. While they had a profitable quarter, this deficit highlights the company's past financial struggles. Let's get back to that credit agreement and that third amendment they mentioned. It seems they altered their loan terms in June of 2025 to get more flexibility. They deferred some payments and adjusted debt covenants. This sounds like a proactive move to manage their debt load, especially considering their revolving credit facility matures in July 2026 and their term loan in March 2026. The report indicates they believe refinancing is probable, but there's no guarantee it will be on favorable terms. Failure to refinance could seriously impact their ability to operate. Their revenue streams are split between electric and coal sales. Electric sales, which come from their Meron power plant, brought in almost $60 million in the quarter. Coal sales from their mining operations brought in another $38 million. What's interesting is their strategy around contracted revenue. They have a solid forward sales position for both energy and capacity. This is like pre-selling their future electricity and the availability of their power plant, so they lock in pricey 26. They have 4 million megawatt hours contracted at an average price of over $43 per megawatt hour. This forward selling is a key strategy to stabilize income in the often unpredictable energy market. Hallador clearly breaks down its performance by segment: electric operations and coal operations. They also have a corporate and other and eliminations category, which includes their investments in other companies. The chief operating decision maker, or CODEM, who is essentially the CEO, looks at how these segments perform, and they use something called EBITDA margin as a key metric. Basically, they are trying to see how profitable the core operations are after accounting for certain expenses. For electric operations, their EBITDA margin in the second quarter of 2025 was almost $16 million. This is up from about $11 million in the same quarter last year. So their power generation business is showing improvement. Now, for coal operations, the picture is a bit different. Their EBITDA margin was actually a negative around $2.7 million for the quarter. This means their mining operations are currently costing them more than they are bringing in on an operational profit basis. While overall company revenue might look okay, this negative margin in coal is a concern, and it shows the challenges they face in that specific sector. In their management discussion, they mention a planned maintenance outage at Marom, which impacted power generation in the quarter. However, they also saw higher than expected energy prices and improved operational metrics at their Uptown mine. They are also actively seeking acquisition opportunities for additional dispatchable generation, which means they want to buy more power plants to add to their portfolio. They are also evaluating the possibility of making Marom a dual fuel plant capable of running on natural gas or coal. This could give them flexibility to use the cheapest fuel available and improve resiliency. The report includes a bunch of forward-looking statements. This is common. They talk about anticipated capital expenditures, future cash flows, and borrowing. But they also list a wide range of risks, from macroeconomic conditions to weather and even international conflicts. They are also keenly aware of environmental regulations and the changing attitudes towards ESG matters. So they are acknowledging the many external factors that could affect their business. You know, looking at all this, Hallador Energy seems to be in a bit of a transformational phase. They are trying to shift away from just being a coal producer to becoming a more integrated power company. The electric operations are showing signs of life with improved profitability and good forward sales, which is a smart strategy. However, the coal operations are struggling with negative margins. This creates a bit of a mixed bag for the company. Their debt levels are significant, and their reliance on refinancing could be a major risk. They need to execute on that refinancing to ensure they have the financial flexibility to continue their transformation and pursue growth opportunities. They are also heavily reliant on customer contracts for both coal and electricity, and the renegotiation or renewal of these contracts will be critical. Overall, Hallador is navigating a complex and competitive industry. They have a clear strategy to adapt, but the execution and management of their debt will be key indicators of their future success. It's a company with potential, but definitely one to watch closely for how they handle these financial and operational challenges. Alright, that's our breakdown of Hallador Energy's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.